Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Becton Dickinson and Company quarterly report. Becton Dickinson and Company offers a wide range of medical supplies, devices, laboratory equipment, and diagnostic products for various industries and individuals worldwide. The company operates through four main segments: medical essentials, connected care, biopharma systems, and interventional and life sciences. Under the medical essentials segment, Becton Dickinson provides a variety of products including peripheral intravenous IV, catheters, central lines, vascular access technology, hypodermic syringes and needles, anesthesia needles and trays, enteral syringes, and sharps disposal systems. These products cater to healthcare institutions, physicians, and the general public. The connected care segment offers a range of products that enable safe medication management, including IV medication safety and infusion therapy delivery systems, automated medication dispensing and supply management systems, informatics and analytics, and pharmacy automation system. This segment also provides hemodynamic monitoring systems and prefilled drug delivery systems. In addition to these products, Becton Dickinson offers specimen and blood collection products, such as automated blood and tuberculosis culturing, molecular testing, microorganism identification and drug susceptibility, rapid diagnostic assays, microbiology laboratory automation products, and plated media products. The company also provides fluorescence-activated cell sorters and analyzers, antibodies and kits, reagent system, and solution for single-cell gene expression analysis. Furthermore, Becton Dickinson offers surgical products, including hernia and soft tissue repair, biological and bioresorbable graft, biosurgery, and other surgical products. The company also provides surgical infection prevention, peripheral intervention, and urology and critical care products. Through its strategic collaboration with ChemoGLO, Becton Dickinson aims to improve the safety of healthcare workers by advancing hazardous drug contamination testing in healthcare settings. With a rich history dating back to 1897, Becton Dickinson has established itself as a leading provider of medical supplies, devices, laboratory equipment, and diagnostic products worldwide. Becton Dickinson and Company market capitalization of $41 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that Becton Dickinson and Company holds a significant advantage in their industry. Becton Dickinson and Company trades at a lower price-to-earnings ratio of 26 times and a lower price-to-book ratio of 1.68 times relative within the industry. This makes the stock valued slightly lower than its peers in the industry. This likely suggests that investors are less interested about the company, or it could be that the stock have not caught up to the industry valuation and should further be investigated. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.85%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, the medical essentials segment has seen significant increases in revenue due to the success of its medication delivery solutions, unit's vascular access management portfolio, specimen management unit's BD Vacutainer TM portfolio, and international sales of BD Roa TM in pharmacy automation portfolio. The connected care segment has also experienced 4.9% revenue growth in the second quarter of 2026, primarily driven by these factors. In addition to these drivers, the biopharma systems segment has seen double-digit growth of prefillable solutions in the biologic drug category, while the interventional segment has witnessed double-digit growth in its urology and critical care units PureWick TM offerings and surgery units infection prevention products and advanced tissue regeneration portfolio. On the decline side, the medical essentials segment has experienced a decline in revenue due to decreased sales of medication delivery solutions and specimen management. The connected care segment has also seen a decline in revenue, primarily driven by decreases in medication management solutions and advanced patient monitoring. The biopharma systems segment has experienced a 7.5% decline in revenue, while the interventional segment's urology and critical care units' PureWick TM offerings have declined. Geographically, the Americas account for 54% of total net sales, followed by Europe at 27% and Asia-Pacific at 19%. Other drivers of revenue growth or decline include governmental receivables, macroeconomic conditions, and regulatory matters. The company faces potential credit losses due to payment dependent on national economies' financial stability and creditworthiness, as well as uncertainty around the duration of current challenges and pressures. Regulatory matters such as FDA consent decrees, inspections, and notices also pose a risk to revenue growth or decline. The net income of the company experienced a significant fluctuation over the past year. For the 3 months ended March 31, 2026, the net income decreased to -$311 million compared to $308 million in 2025. However, for the 6 months ended March 31, 2026, the net income increased to $72 million from -$611 million in 2025. On an annual basis, the net income also declined to $274 million from $611 million in 2025. The profit margins of the company also underwent a change. The operating income margin decreased to 1.96% for the 3 months ended March 31, 2026, down from 8.58% in 2025. Conversely, the 6 months ended March 31, 2026, saw an increase in operating income margin to 6.12% from 7.53% in 2025. The net income margin also experienced a decline for the 3 months ended March 31, 2026, dropping to -6.59% from 6.88% in 2025. The reasons behind these changes are attributed to several factors. A decrease in income from discontinued operations and an increase in depreciation and amortization contributed to the decline in net income. Additionally, asset impairment charges also increased, further affecting the company's financial performance. The company's financial performance indicates a strong ability to generate cash from its core operations. A review of various sections of the report reveals consistent evidence of positive operating cash flow. On page 4, it is inferred that the company generated $1,431 in operating cash flow. This trend continues on subsequent pages, with net cash provided by continuing operating activities reaching $1,328 million in 2026 and $489 million in 2025. Furthermore, the report highlights significant operating cash inflows of $1.4 billion, demonstrating a substantial influx of funds into the company's operations. The data presented on page 59 also supports this conclusion, showing that operating activities generated $1,328 million in 2026. Additionally, pages 60 and 61 explicitly state that the company is experiencing positive operating cash flow in 2026. The absence of any mention of negative operating cash flow or significant debt repayment issues further reinforces the notion that the company is successfully generating positive operating cash flow. Overall, this suggests a healthy financial position for the company, with its core operations contributing positively to its bottom line. The company's financial performance has shown some fluctuations in its debt levels and interest expenses. While the interest expense decreased by $3 million from 2025 to 2026, as mentioned on page 2, this trend is not consistent across all periods. In fact, page 28 notes that there was no change in net interest expense. Regarding the company's debt level, the picture is mixed. On one hand, page 60 reports a decrease in total debt from $19,180 million to $17,279 million. However, other pages present conflicting information. Page 4 indicates that current debt obligations increased by 66%, while long-term debt decreased by 16.7%. The overall trend is unclear, making it difficult to determine if there has been a significant change in the company's debt level or interest expenses. The performance of various segments and regions within the company has been mixed in recent years. On a positive note, medical essentials experienced significant revenue growth of 23% in 2026 compared to 2025. The Medication Management Solutions unit also performed well, generating $2.3 billion from existing contracts and minimum purchase commitments. In contrast, Connected Care and Biopharma Systems struggled with revenue declines of 3% and 21%, respectively. These segments underperformed across both the United States and international regions. Medical essentials, however, continued to thrive in both markets, with growth rates of 22% and 23%. The performance of other segments, such as Medication Delivery Solutions Unit, BD Medical Essentials, BD Connected Care, BD Biopharma Systems, and BD Interventional, remains unclear due to a lack of specific information. Management is optimistic about the company's outlook, citing a focus on executing its growth and profitability strategy. The investments in research and development (R&D) are yielding positive results, leading to increased net income. To further boost shareholder value, management is prioritizing share repurchases and dividends. The company's financial performance is also expected to be strong, with a positive outlook on retained earnings due to a significant net cash distribution of $3.857 billion. Management is committed to preserving the intrinsic value of share-based awards after the spin-off. However, management is not without concerns. They are assessing the potential impact of new accounting principles related to software costs and expecting unfavorable conditions due to global economic downturns and macroeconomic trends. To mitigate these risks, the company's strategy for growth includes managing supply chain disruptions and increasing borrowing costs. Management is investing in various initiatives to drive growth, including R&D, strategic acquisitions, geographic expansion, and new products. They are also focused on sustaining long-term growth by expanding the core business, developing innovative products, improving operating efficiency, and organizational effectiveness. Additionally, management is prioritizing capital expenditures that enhance cost structure and manufacturing capabilities. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends. The company has indeed paid dividends, as confirmed on page 13 of the report. This indicates that it has distributed a portion of its profits to its shareholders in the form of dividend payments. In addition to paying dividends, the company has also engaged in share buybacks. Multiple pages within the report confirm that the company has repurchased significant amounts of its common stock. For instance, page 50 notes that approximately $2.25 billion was spent on buying back shares. This suggests a deliberate effort by the company to reduce the number of outstanding shares and potentially boost earnings per share for remaining shareholders. The company's financial reports reveal concerns about inventory buildup and supply chain disruption. In terms of inventory buildup, the data shows that inventories have been increasing over the past 2 fiscal years, with a significant amount of $745 million in 2026. This is also reflected in the biopharma segment, where cost of products sold accounts for 54.1% of revenues. Furthermore, the company's accounts payable and inventory levels indicate higher levels of inventory compared to accounts payable. This suggests that the company may be holding onto more stock than necessary, which could lead to cash flow issues and reduced profitability. Regarding supply chain disruption, the reports highlight several potential risks. These include market dynamics in China, ongoing conflicts in Iran and the Middle East region, and disruptions in sourcing, manufacturing, and distribution. The adverse impact of tariffs on supply chain costs is also a concern, as it can lead to increased expenses and reduced profit margins. Additionally, the company's gross profit margin has been affected by unfavorable impacts from tariffs, foreign currency translation, and higher labor costs. These factors have resulted in a decline in the company's profitability. The disruptions in global supply chains due to economic downturns, inflation, tariffs, and trade policies further exacerbate these concerns. That concludes the financial summary for Becton Dickinson and Company. Feel free to comment below, and I will be happy to answer them when possible.